Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The market saw a true seismic event on January 5th, 2026. VerifyMe Inc., ticker VRME, announced a binding letter of intent to merge with OpenWorld Ltd. And this wasn't just some, corporate pivot. It was a revolution. We are watching a company basically jettison its entire legacy in precision logistics to place this massive Hail Mary bet on Web3 infrastructure. The price action was, it was immediate and stunning. The stock spiked an incredible 75% in a single session.
And at Sputnik, I think that defines the volatility we really need to dissect here. The sheer mechanics of the move are, frankly, alarming. Volume just exploded. We're talking over 2.5 million shares traded hands. That rapidly turned over a huge chunk of what is an incredibly small effective free float, maybe around 8.7 million shares. So this announcement has fundamentally cleaved VRME into two mutually exclusive things. You have the struggling microcap logistics provider it was last week versus this highly speculative, high beta play on real-world asset tokenization. So the central question for us is this merger a legitimate strategic cure for the company's deep-seated issues? Or is it just an excessively dilutive event built for short-term speculation on a failing public vehicle?
Well, I'm firmly in the camp that this merger is a strategic necessity. I see this deal as an accretive paradigm shift. It provides the only viable solution to the existential threat that VRME was facing, which was, of course, that NASDAQ non-compliance risk. The stock was heading below $1 a share, and this is a clean break. It's a path to exponential growth.
And I'm approaching this purely from the perspective of risk. The extreme dilution, a truly staggering 90-10 split, coupled with immense execution risk. I mean, you're pivoting to an unproven technology. That, to me, far outweighs the benefit of just, curing a NASDAQ listing problem. I see this as a classic bull trap.
I see why you emphasize the danger, but this event, it fundamentally invalidates the entire prior bear thesis. That old thesis was anchored in tangible decay, right? A 14.2% year-over-year revenue decline and the near certainty of a delisting notice. This deal provides an immediate regulatory cure. That alone justifies a lot of the price movement. But beyond just compliance, it unlocks a massive valuation arbitrage. As a decaying logistics company, VRME traded at what, about 0.4 times sales?
Right.
Moving to a Web3 infrastructure layer allows the market to apply a significant tech premium. You could see that multiple reset closer to 4 or 5 times sales, putting it in line with companies like APDN. And we can't forget the immediate tangible return, the special dividend. With $4 million in cash and $1 million retained, we are looking at roughly 24 cents per share paid out. That was an immediate 40% yield for anyone holding before the merger. It provides a crucial floor.
Okay, a cushion. I'll give you that. The dividend provides a necessary cushion, but let's be honest about the cost. A 90% dilution means legacy shareholders are left with just 1/10 of the combined company. They are relying entirely on the new OpenWorld entity commanding a market cap that is 10 times higher than VRME's pre-merger valuation just to get back to square one on their equity. And that's not even counting the dividend.
Well, you're pricing in the future.
I am pricing in the math. It's an enormous requirement for success. And moreover, the core asset is no longer the logistics business, no matter how much it was declining. It's the speculative promise of RWA tokenization, a market that is notoriously, susceptible to hype cycles and buzzword-heavy narratives that promise way more than they deliver. My primary concern right now isn't the future, it's the present fragility of this agreement. This is a letter of intent, a binding one, yes, but it comes with a 60-day exclusivity period for due diligence. This merger failure risk is palpable. If the deal collapses, and 2 months is a long time in this space, the stock reverts instantly to its pre-merger risks. I mean, remember, the bear thesis was totally rational. The company lost $3.4 million in Q3 2025. It had a history of failed products, and we all saw that massive $3.9 million PeriShip impairment charge. The new public vehicle inherits that exact same track record of execution risk.
Okay, but let's talk about that price movement again, because I think this is where our core disagreement really lies. I see the 75% jump as fundamentally justified You seem to see it as a technical squeeze.
I think it was both, but the squeeze absolutely drove the magnitude of the move. Look, the official short interest was small, around 326,000 shares, but it was concentrated. It was structural shorts betting on that delisting death spiral. When the LOI was announced, those shorts, who were probably sitting on paper profits, were forced to cover. And given that tiny effect of free float, that covering it created a vacuum. There was no depth of sellers to absorb the buying pressure, and that led to an unsustainable spike. The move was violent because the float is so constrained. It's technical volatility masquerading as fundamental conviction.
I see why you highlight the technicals, but I have to disagree that it was masquerading. The removal of the delisting risk is a fundamental change. Structural shorts were actively pricing VRME for, 30, 40 cents? When that floor was violently removed by a credible merger partner, the resulting price correction was, necessary. This isn't just a technical bounce, it's a repricing. It reflects the company's new optionality. And the volume, that reflects genuine conviction in the new story, backed by the credibility of open world associations. We're talking about a firm with backing connected to Tier 1 VCs. That pedigree, that institutional interest, it lends undeniable weight to the pivot.
Institutional associations are one thing. Verifiable revenue is something else entirely. And that forces us to look at the leadership transition, because that's where investor trust is really being tested.
I think it's a huge positive. Outgoing CEO Adam Stedham's reputation as a pragmatic operator and a seller is completely validated by this exit. He successfully positioned the company for this capital event, much like his prior sale of GP Strategies. And critically, he stabilized the balance sheet. He kept the cash above $4 million, and he cleared the decks, executing that Perry-ship impairment when it was necessary. He de-risked the legacy structure. Then incoming CEO Matt Shaw, he brings the critical Web3 native expertise and access to institutional crypto capital. You simply can't execute a pivot of this scale without that kind of divergent skill set.
That's a very clean narrative, but I have to frame it differently. Stedham may be a pragmatic seller, yes, but he sold the company at a catastrophic cost to existing shareholders, a 90% wipeout. His competence stabilized the cash, sure, but it completely failed to stabilize revenue or generate any sustainable profit. And as for Shaw, the incoming CEO, his background is, well, it's non-traditional, even for Web3 music and writing. So investors have to take this massive leap of faith that his claimed experience as a launch partner for protocols representing over $65 billion in on-chain value will actually translate into real high-quality recurring revenue.
But that is the nature of a technology pivot. You acquire the expertise and the network you need to grow. Shaw is bringing that network.
But the $65 billion figure is aggregated network value. It is not revenue directly attributable to open world, and that's a huge conceptual gap that relies on promotional language, not fundamental metrics. He's a promoter-operator, and the deal feels designed to maximize his team's gain by minimizing the cost of the public shell.
If we're going to talk about minimizing cost, then we have to go back to the 90-10 dilution, because that seems to be your core structural objection.
It's mathematical. It's not personal. The structure is punitive. To realize value beyond that dividend, the combined entity has to achieve a valuation that is at least 10 times the pre-merger market cap of VRME. Based on the suggested crypto comps, that means Open World needs to command a market cap in the range of $50 to $200 million, almost immediately. This isn't just incremental growth. This requires explosive, flawless execution right out of the gate. I maintain the structure strongly suggests that Open World is primarily just using this to acquire a clean, cheap public vehicle, exploiting VRME's cash and its NASDAQ listing. It looks like an acquisition of a shell, just dressed up as a synergistic merger.
I'm just not convinced by that line of reasoning, because you are clinging to the valuation of the old defunct company. The entire premise of this deal is that the old valuation is irrelevant. If the merger is successful, the combined entity will command a multiple expansion from, say, 0.4 times sales to 4 times sales. That multiple expansion is the primary driver of value. It makes the pre-merger market cap a meaningless yardstick. Even if you only hold 10% of the new entity, if that new entity is valued at 5 times the old market cap, you've created immense wealth, and you have the 24-cent cash cushion.
But the risk of failure is exponentially higher. Look, let's talk about the use of that treasury. You highlighted that the legacy business showed positive cash from operations, a commendable $200,000 in Q3. That stabilization, which I acknowledge, it preserved the treasury. But what is OpenWorld actually getting here? A clean NASDAQ listing, $3 million in net cash after the dividend, and a history of execution failure. That cash is just the bridge capital they need to implement a pivot that has zero verifiable revenue streams. We are trading a known weakness for binary winner-take-all speculation.
We are trading a declining certainty for exponential potential in a secular growth trend. The RWA tokenization market is projected to explode in 2026. This merger is the only viable path for your Emmy hat left. It cures the threat of delisting, and it provides access to that upside. And the technicals we discussed, the small float, the squeeze potential, that will provide crucial price support while the market takes the next 60 days to process this fundamental shift from a dying logistics company to a high multiple Web3 infrastructure play.
I see it differently. The shift is pure high-stakes speculation defined by immense downside. Investors are trading a tangible, if troubled, business for a speculative, unproven concept under the temporary shadow of an LOI. The 90% dilution, the history of failures, the fragility of the due diligence period, it means the stock remains a quintessential bull trap until the deal is officially closed, and Matt Shaw delivers concrete, high-quality revenue. Until then, we're relying entirely on buzzwords.
This is a truly remarkable case study. I mean, the evidence clearly suggests a fundamental clearing of the most pressing risk, that NASDAQ noncompliance. Yet, the execution risk remains exceptionally high. It forces investors to weigh the immediate certainty of that 24-cent cash return against the future exponential but profoundly uncertain growth potential of the RWA market.
Exactly. And the decision for every legacy shareholder rests entirely on one question. Do you believe the new pie, this open world entity, will ultimately be large enough, and I mean 10 times larger, to fully compensate for the small 10% slice you get to keep? That level of success is it's far from guaranteed.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.